Studying about financial system stability, we have discussed a lot in the previous lecture. So, we have discussed about what is the definition of financial stability and what are the financial system stability. And now we'll discuss financial system stability. Uh, Financial system stability is important for four reasons. First one, a stable financial system creates a trusting and enabling environment favorable to savers and investors. When people are going to give their money into the banking system or in the financial system of a country, that such a banking or financial system of the country should should have a trust among savers and investors. So it should provide a trustable, favorable environment to them. So if an economy having uh, a stable financial system that will create a trusting and enabling environment that is favorable to savers and investors, then we can expect a smooth flow of fund among savers and investors, and national economy will grow up. The second reason why we need a financial system stability, so it helps the transmission of monetary policy. Time to time, the Central Bank of Sri Lanka, on behalf of the government, implementing monetary policies and fiscal policies. And monetary policy, monetary policy is very important to ensure financial system stability, and it's about money supply and interest rate, that sort of things. So it helps to the transmission of monetary policy, thereby assisting the attainment of price stability. The price stability includes inflation, general price level of the country, interest rate. So that sort of issues will be handled by the central bank using monetary policy. To better implement such monetary policies, a government, a country, an economy should have a good financial system stability. And the third reason why do we need a financial system stability, a stable financial system encourages efficient financial intermediation, which eventually promote investment and growth. In the economy, if savers and investors, borrowers, lenders are experiencing, are having they're feeling a good environment of financial system stability, so they do business, they are willing to participate some sort of financial activities. So in that time, more financial intermediaries come forward, and they will work efficiently. So that will encourage the movement of cash flows among the lenders and borrowers. So it will encourage uh, economic growth. It will encourage. So the efficient financial intermediation will promote investment, and that investment will lead to the growth and finally the economic development. The fourth reason, a stable financial system encourages effective and efficient operation of market and improving distribution of resources in the economy. Here they are mentioning about market, about capital market, especially financial market, stock market, debt market. And in our country, we have Sri Lanka Stock Exchange. So if financial system is stable, we can expect an effective and efficient financial operation. So this efficient operation of capital market is functioning well to allocate resources in efficient manner. Now we'll discuss about consequences of financial system instability. So what will happen if the financial system become unstable? If financial system is not stable, we will not be able to undertake such transaction of money safely, because some financial institutions may fail to repay our deposit, disburse loan, or remit the payment to due parties locally and abroad. You know, if the financial system is not stable, for example, the banking system of our country is not stable, so many people are not many people. Most of the people are not willing to go to that bank. They are not believe at all. Once we deposit our money and the later period we go and ask for our deposits, they will dishonor our deposits. They will say we don't have no money. We are under the financial crisis, don't ask money from us. So this kind of answer we can expect. If we deposit money on behalf of someone else, third party account, and sometime the bankers or the intermediaries will abuse that money. So it will happen when a country experiencing a financial system instability. And financial instability generally implies a situation of widespread failure of bank, financial institution, and payment schemes, payment system. You know, once the one bank collapse, assume that, for example, a large bank in Sri Lanka, if collapsed, what will happen? It will not affect only one sector, not, or it will not impact only the depositors, not only the borrowers. It will impact, it's like COVID-19 pandemic, right? So everybody are linking together, right? They are doing business. Many people are business, rotating the money. They're rotating the flows. If there are any blocks in the rotations, then it will impact, it will create a big disaster in the economy, widespread failure. If one bank fails, what will happen? Say for example, one company has a deposit in a bank A. The bank A collapsed, bankrupt. Then the company, that a particular company, not able to pay their suppliers, not able to pay their salaries to the employees. They're unable to run the business, and the employees of that company will impact, affected. They will lose their job, and it will, it will adversely impact on their economy. A particular bank is unable to settle the loan to the supplier, then supplier operation will be struggled, blocked. So it will create a big problem in the country if a single bank failures. Firms and business community will suffer from non-availability of loan facilities to the finance of their business. Then a, a, if a country facing on financial instability, they are unable to get resources for their business, especially they are unable to get a loan from any bank or any other financial institutions. International transactions, export, import, remittances, etc. will be badly affected. Think about a situation where we couldn't find any banking service. So what will happen? Can you buy product from abroad? Can you send money? Can you send product? Can you receive money? No, it's very difficult. So absence of financial system is equal financial system with instability. We have no trust. Our public have no trust on the system. So banks are there, banks may be there, but If it's unstable, then the trust will go down. It's mean instability, financial system instability. Causes of financial system instability. What are the causes? What are the effect of financial system instability? So widespread failure of banks and financial institutions is a common features of financial crisis. In the financial crisis, it's like a COVID-19 pandemic. If one bank, one financial institution affected, then it will spread out, widespread of failure of banks and other financial institutions. The best example is the Lehman Brothers crisis in 2007 in USA. So it simply called as the world financial crisis in 2007. It was spread all over the world, but the institution is based in USA, but it spreads all over the world. So weak risk management of bank. So weak risk management of the bank. The bank doesn't give more attention on the risk management. The sudden outflow of foreign capital invested in the country. Now, a big investor, a significant investor is doing the business in a country. Due to some reasons, that investor has decided to go back their capital investment to their own country, then it will generate unexpected sudden outflow of money from our country. Then many our system, banking financial system, will become questionable. Economic downturns, when the economy, economy is go down, economies fall down. So this situation is a good example. Many companies, many financial institutions, not only financial institutions, many institutions are affected due to the COVID-19. So it's an economic downturn, a rapid liberalization. In 2007, USA, the Lehman Brothers failure. So most important reason is cited by many scholars that they liberalized the regulations. So due to that, the banks able to give a lot of money to their customers, borrowers, mortgage, especially mortgage. So due to that, many people are willing to get loan. A bank at that time doesn't care about the ability of repay of money. So banks are very interested, very eager. They are eager to give loan, mortgage loan to their customers. So therefore, customers also, so bank also be ready to give loan, and customers also very like to get loan. Very much like they are very much interested to get the loan. So both sides, the banks are giving loan, the public are getting loan because of the rapid liberalization. The government has fluctuated the restrictions on loan provision. So therefore, many people get the loan, but at the time of repay of money, many people, many public, many customers are not able to pay money. Then how a bank get money, how the banks get deposits, how can they get the principal, how the bank run out of money, then investors are disappointed. Then finally, so banks are running out of money, so therefore it will lead to bankruptcy of the bank, and finally it spread all over the world. So that was the best example for the Lehman Brothers 2007 financial crisis. Is arises due to rapid liberalization of regulations. Inadequate economic policy. Inadequate economic policy also will lead instability. And inadequate resource allocation, we have some kind of businesses have a lot of growth potentials. There are more space to grow up, but due to some political reasons, due to some reasons, they are not allocate resources equally, or uh, they are not allocate resources based on their potentials. So uh, financial system instability arises, and non-creditable economic rate, slow economic growth rate, and poor supervision. So what is happening, if the regulatory authorities fails to monitor closely, effectively, then there is no space for fraudulent activities, forgeries. But so due to the poor monitoring, poor supervision, many peoples, or some peoples, especially mafias, dominate the market, and it leads to financial system instability and poor accounting and auditing. So these are the causes for the financial system instability. So factors affecting financial stability. What are the factors influence on financial stability? So stable macroeconomic environment. There's no much up and down. So it's one of the indicators of a good stable macroeconomic environment. So uh, they can we can expect a good financial stability. So United Kingdom, German, France, USA, they have a stable macroeconomic environment. But some countries like Zimbabwe, Kenya, so such countries does not have enough, not much macro, that much stable macroeconomic environment. So therefore, uh, every time they are ending up with uh, financial system instability. Right? Very largely. Likewise, the systematic risk is the financial imbalances that build up gradually. Right? Bitter and bitter, they will step by step. Initially, it will develop step by step. After a certain stage, unrevealed suddenly. Right? It will increase very suddenly, like open the gate in the river, across the river, right? So already the gate was closed. There's a dam. So what will happen? The dam, when the dam is opened suddenly, so likewise financial instability will be collapsed quickly. And contingent risk, it's mean if in one organization, if one bank collapsed, then uh, it will start to transfer that risk to other company, other bank also. And initially idiosyncratic problem that become more widespread, often in a sequential fashion, like COVID-19 pandemic, how it spreads likewise. Shared exposure to financial market shocks, adverse macroeconomic developments that affect a range of financial intermediaries and market at the same time. Finally, all the system will be collapsed. System will be collapsed. So how to measure systematic risk? How to measure systematic risk? It's like what? It's like a cyclone, right? The risk can be found everywhere. So each and every bank, each and every market, each and every stocks have this kind of risk, right? It's come from anywhere, right? It will impact here, Wall Street. This picture is Wall Street. So anywhere it So initially it developed very small scale, and it's developed like cyclone, and it will affect the system. So identification of systematic risk is far from straightforward. It's not a simple task. Identification of systematic risk is not a simple task. It is far from straightforward, given that systematic risk per se are complex and multi-faced. The measuring systematic identification of systematic risk is not a simple task. It is multi-faced. It's a very complex. So there is a need to have a wide range of measures and tools covering different aspects of systematic risk. The systematic risk arises in different dimensions, different shapes, different scenarios. So therefore, to identify that kind of systematic risk, we have to government should implement a wide range of measures and tools. Host of new quantification measures have. So we have to use a new kind of tools, measurement tools. Post the crisis, after the crisis, emerge in academic literature. Many academics, lecturers, professors will write about that risk. While central banks are developing tools, so meanwhile, the central banks will introduce some new policies, act to uh, overcome that kind of systematic risk, and techniques which will help identify and measuring systematic risk. Measure of systematic risk contribution. So, treat systematic risk as an extent to which individual financial institutions pollute the public good of overall financial stability. No, in the system, one organization is enough. One organization is enough to pollute, to collapse all the system in the country. So that's why the Central Bank of Sri Lanka is closely monitor all the financial institutions in Sri Lanka. They are very serious. Central Bank is very serious on the monitoring of commercial bank, especially commercial bank, because if one bank collapse, it will totally almost collapse every each and every institutions in Sri Lanka. So focus on systematic risk contribution of individual organization, right? So each and each and every organization systematic risk contribution to systematic risk is very important. In principle, such measures, if accurate, could be used for Pygovian taxes, leaves, or other regulatory interventions aimed at internalizing the negative externalities. So, if they have a good system to control the systematic risk, so if they identify anything, if they indicate anything will cause for contribute financial system instability, the government can control by using paying taxes, so living taxes or penalties. So some or different kind of uh, other tools. They can imprison the correspondent, or they can, so anyhow in any other ways they have to punish them. So the additional capital surcharges proposed to be levied in globally systematically important banks. So they may charge fines if they are violate the rule, if they are giving a light indicator that will lead to financial system unstable or bankruptcy. So that time they will, the government will do something. So modeling risk of aggregate shock. How to a model, how to develop a system to identify that kind of risk, a kind of systematic risk. So modeling the risk of aggregate shocks. Focus on the impact of macroeconomic shock on the financial system. Focus on impact of macroeconomic shocks on the financial system. So think about if right. Uh, so very easy example.